There is an interest rate that affects more Americans than any rate the Federal Reserve sets. It is not the mortgage rate. It is not the savings rate. It is not the rate on your car loan. It is the rate on your credit card. And right now, that rate is sitting at 20.94%. Not 5%, not 8%, 20%. On the money you already spent, on the groceries, on the utility bills, on the car repair you couldn't afford to pay in cash, on the medical bill that arrived without warning. The Federal Reserve gets covered every time it moves rates by 1/4 of a point. Financial media breaks down every basis point of every Treasury yield. But the interest rate that is quietly compounding against millions of American households right now, the one sitting at nearly 21%, barely makes the news. Today, we are going to talk about what that rate actually does to your financial future. Not in theory, in math. First, the scale of the problem. American households are currently carrying $1.3 trillion in credit card debt. That is not a typo. $1.3 trillion. It is the highest level ever recorded in the history of the United States. Higher than during the financial crisis, higher than at any point in the last 25 years of data tracking. And it did not get there because Americans are reckless with money. It got there because the math of daily life stopped working for a large portion of the population. Since 2020, grocery prices are up 25%. Housing costs are up over 30%. Car insurance has risen nearly 50%. Utility bills climbed 12% in a single year. These are not luxury expenses. These are the fixed costs of existing. And when those costs rise faster than income, the shortfall has to go somewhere. For millions of households, it went onto the card. The average American credit card holder now carries between $6,500 and $6,800 in revolving balance. That is the balance they carry from month to month, not the amount they charge, the amount that stays. 47% of all credit card holders carry a balance month to month. Among Gen X, people currently between 46 and 61 years old, that number is 53%. Among millennials, 30 to 45, also 53%. The two generations closest to retirement age and the age where wealth building should be accelerating are the ones most likely to be carrying high-interest debt into every new month. Now let's talk about what 20.94% actually does. Because the number sounds bad, but most people do not have an intuitive sense of how bad it really is. Compound interest works in both directions. It is the mechanism that builds wealth when it works for you, money earning returns that earn more returns. And it is the mechanism that destroys wealth when it works against you, debt growing on top of debt, growing on top of debt. At 20.94% APR, a $6,700 balance, roughly the current average, costs you $116 in interest in the first month alone. If you make only the minimum payment, you will spend more than a decade paying off that balance, and you will pay back nearly double what you originally borrowed. Here's the comparison that makes this concrete. The stock market, specifically the S&P 500, has returned an average of roughly 10% per year over the long run. That 10% is what financial advisors point to when they talk about the power of long-term investing. That 10% is the foundation of most retirement planning models. Your credit card is compounding against you at more than double that rate. Every dollar sitting on a credit card balance at 20.94% needs to earn more than 20.94% somewhere else just to break even. That return does not exist at manageable risk levels, which means every dollar of credit card debt you carry is a dollar that is actively making you poorer every single month, faster than almost any investment can make you richer. This is where the retirement connection becomes impossible to ignore. A survey by Schroders, published in July 2026, found that 1 in 3 Americans currently carries more credit card debt than retirement savings. Not more debt than their emergency fund, more debt than their entire retirement account. Think about what that means structurally. These are people whose net financial position, when you subtract the 20% liability from whatever they have saved, is negative before they even start calculating retirement. And the compound math works against them in two directions at once. Direction 1. The debt side. A $6,700 balance at 20.94% grows to approximately $8,100 after 1 year if you make no payments. After 5 years of minimum payments, a significant portion of every dollar paid has gone to interest, not principal. The balance barely moves. Direction 2. The savings side. Every dollar that goes to minimum credit card payments is a dollar that does not go into a retirement account. At 10% average market returns, $200 per month invested over 20 years becomes approximately $152,000. That same $200 per month spent on minimum credit card payments over the same period builds nothing. It services a liability that is growing faster than it is shrinking. The retirement savings rate in the United States tells this story directly. The personal savings rate has collapsed from 6.2% in early 2024 to 3.9% in 2026. People are earning more than they were 2 years ago. They are saving less. The difference is being consumed by the cost of living and the cost of servicing debt. Here is the part that makes this a systemic problem, and not just a personal one. When nearly half the population carries high-interest debt month to month, and that debt compounds at 20%, the households carrying it are structurally prevented from building wealth. Not temporarily delayed, structurally prevented. The math does not allow simultaneous progress on both sides. And this falls hardest on the generations that can least afford the delay. Gen X is already running behind on retirement savings. The median Gen X household has approximately $40,000 saved for retirement. The commonly cited target for retirement readiness at their age is closer to $250,000 to $300,000. They are already facing a gap, and 53% of them are carrying credit card balances at 20% interest that are actively widening that gap every month. Millennials are in the wealth-building window, the years between 30 and 45, where compound interest has enough time to do significant work if you can get money into the market and leave it there. But 53% of them are also carrying balances. Every year of the wealth-building window spent servicing 20% debt instead of building assets is a year that does not come back. The financial media covers retirement savings as a behavior problem. People are not disciplined enough. People spend too much on things they do not need. The data does not support that story. The savings rate collapsed at the same time that housing, insurance, groceries, and utilities all rose by double digits. People are not saving less because they bought more lattes. They are saving less because the fixed costs of their lives consumed the margin that used to go into savings. And when that margin disappeared, the credit card filled the gap at 20%. The Federal Reserve tracks mortgage rates. Financial journalists track Treasury yields. Your bank tracks your credit score. Nobody is clearly telling the 47% of American credit card holders who carry a balance that the rate compounding against them every month is more than double the long-run return of the stock market. Nobody is explaining that 1 in 3 people saving for retirement is simultaneously running a 20% liability that mathematically offsets whatever they manage to accumulate. Nobody is saying that the savings rate did not collapse because people became less responsible. It collapsed because the costs of housing, food, insurance, and utilities rose so far and so fast that the money simply was not there anymore, and the credit card became the mechanism for managing the shortfall. That is not a personal failure. That is a structural condition. And understanding it as a structural condition is the first step to making decisions that actually address it, rather than feeling guilty about a problem that the financial media has systematically misdescribed. The 20% interest rate is the most consequential rate in the American economy right now. It touches more households than the Fed funds rate, It does more damage to long-term wealth than any market downturn, and it runs quietly in the background of nearly half of all American financial lives. If you want to understand the forces actually shaping your financial future, not the version designed to fit a headline, hit subscribe.